Let's talk about it all as we say yo. Yes, I'm already tired of it myself. In our closing bell exchange today with Dick Burridge from RMB Capital, Peter Anderson from Congress Wealth Management. There's Heather Hughes from Sun America Funds, Jeff Taylor from Digital Risk, and our own Rick Santelli as well. Heather Hughes.
Yes, sir.
Gold.
What are you doing? Gold bugs, jitters, huh?
Is that for real? What do you think? I mean,
heading higher. Yeah, I mean, well, look, we're all wondering if inflation, if we're going to get an uptick in inflation, as we have already seen one from April to May right now. I think, look at food and fuel even, not just gold. That's what's important, I think, to middle-class Americans and the retail investor. You go to the grocery store, food prices are rising. You go to the pump to fill up your gas tank. Gas prices are rising. So I think that could be a concern on the horizon, and that's why you're seeing some money move into gold, perhaps.
Peter Anderson, how do you tie that back to what's happening in stocks today, what's happening in the bond space?
Well, you know, I was really happy yesterday with the results of the press conference. I thought Chair Yellen did a fantastic job. You know, I have been a critic in the past, Kelly, and I think this is her second press conference. She is really getting the training wheels off and being much more clear. I think the one thing she might regret is what you opened the show with, talking about there is the noise of the data, and that might be triggering a gold price increase just because people are very much, you know, very nervous, watching and hanging on every word she says.
Do you think it was appropriate for her, Peter, to say that stocks were not overvalued right now, in her opinion?
Bill, you know, that's another amazing thing. You know, I'm watching this thing certainly with the interest as an investor and portfolio manager, but just as an academic, you know, you're listening to these things that she's saying. It is truly a new age where she is being so forthright with disclosing, giving opinions on everything, even volatility in the market. You know, 10, 20 years ago, you would have never heard a Fed make those kind of comments. Right. So I do think it is a very new thing. I'm not certain how it's going to play out. If you ask me, I think it might be too much disclosure, but hey, that's the plan we're given, and we have to learn to work with it right now.
Yeah, we all asked for transparency. We wanted a Federal Reserve or chairwoman or chairman that's transparent, and sure, here we got it, and maybe
we have it in
too
spades.
much.
Yes,
that's for sure. Dick Burridge, what do you think? Do you like stocks here, or do you think that they're overvalued here?
I think smaller stocks in the U.S. are overvalued. They're extended. They're in the middle of a correction. Larger companies, I think, are fully priced. I do think before the bull market is over in the U.S., you're going to see stocks to 20 or 30% higher, a lot more volatility between now and then as we get there. On the other hand, I think the rest of the industrialized world in Japan and in Europe, stocks are still very reasonably priced. So we would shift more money from the U.S., high-quality U.S. companies, to higher-quality European and Japanese small-cap stocks.
Look, Jeff Taylor, let's talk a little bit about why this happened this afternoon. So it seemed as though, and this is what our cash room was just indicating as well, perhaps it ties back to the TIPS auction. Since that inflation expectations are moving higher, do you sense some kind of regime shift here underway?
You know, I do a little bit. It's interesting because what we're really following is you look at interest rates. It's still been historically low, yet the housing market's still not coming back. We were set last year, we did 6 million houses. Now we're on a track to do about 4.6. You're still not seeing that first-time home buyer come back to the market right now. Too much on that.
So do you fade this move then if you don't think this is all sustainable?
I think we're going to have a little correction. Yeah, I think it's going to come back to us.
In stocks, and what about gold?
Gold, I think is still it's kind of fairly priced right now.
So all right, fairly priced there, but you're worried about a little bit of a move back in stocks.
A move back in stocks.
Okay.
What about you, Rick Santelli? Why is gold up almost $50 right now?
Because I think whether you look at the White House, you look at foreign policy, you look at Congress, or yesterday's Fed meeting and the answer to the inflation question, I think there's a nervousness about how the country's being run from kind of a corporate boardroom perspective. We all understand that if you don't have confidence in the board, you're not going to necessarily like the stock price, and I think that's what's going on with gold. Listen, if you think continuity isn't a great theme for a new Fed chairman, or you think foreign policy's up in the air, or you don't like government entities that lose emails and hard drives when you're not allowed to do the same thing, maybe gold does look like a pretty decent investment. And I will tell you this, it's pretty amazing that the war between below trend growth versus higher prices really in many ways changed yesterday with Janet Yellen and Steve Leisman. Kudos to Leisman, because if you don't appreciate the attention given by Janet Yellen to the pricing pressures in commodities, maybe it makes you nervous that continuity at any price may be a flawed strategy, and there was a real U-turn in interest rates, although they have moderated a bit. Remember, Philly Fed gives you two things no other one gives you. Not only were prices paid up 12, but prices received were down 2.9. Yeah. Think about what that says. Prices are going up, but it's hard to pass them along. Right. Doesn't sound like a winner to me.
In fact, we'll talk about the Fed and inflation expectations next segment as well, Kelly.
And by the way, what Rick's saying has some people in the equity space worried. It ultimately is margin pressure. You know, that's why Kroger's results are so interesting, because they could feel the squeeze here if you want to get in between, you know, the cost of food and some of the products that you're moving on. They did all right today, but in any case, Heather, should margin pressure be a concern here?
Yeah, again, food and fuel are most important, I think, to middle-class Americans and the average retail investor. Equity markets still seem to do okay thus far. It seems like not even inflation is derailing these markets, or geopolitical tensions, which maybe also alludes to the fact of flocking to gold as a safe haven. You look at, we crossed the line in Syria, right? Markets ignored it. Putin's advancement and surge into Ukraine, markets ignored it. Now, even with the civil unrest in Iraq, markets are still ignoring it. So they seem pretty resilient right now. I'm not sure what could crack these markets, if not inflation, you know, a mini ice age. I'm not sure.
Yeah, that's the question I've been asking Peter Anderson. What would cause a 10% correction in this market finally? What's this market waiting for here, do you think?
Well, you know, I think if you cannot find any more stocks out there that are undervalued, Bill, then people are going to start to get impatient, and they're going to start to conclude that everything is overvalued. But I have to tell you, Bill, right now that just is not the case. You know, to bring this conversation back to what we're all interested in, which is how do we make money in this market, I would say that you can still find stocks in certain industries that are at, say, their addressable markets, for instance. They're still not recovered. You know, you look at the S&P 500, it's back or above where it was from 2008, right? But there are, most industries are like that too. However, there are some companies out there that are not back yet to that level. They're back to, say, 2002, 2003 levels. Those are the things I get excited about, and as long as there are things like that out there, I'm not expecting a wholesale correction like that.
All right. Yeah, Larry Fink.
Kelly, real quick, did you notice the Wall Street Journal article? $204.2 billion in buybacks and dividends year to date. That blows away. The last time it was anywhere near here was the fourth quarter of 2007. Ponder that time.
But Rick, here's what's interesting, though. This year to date is the first time in the last couple of years that the dividend and buyback indexes aren't outperforming the S&P. So for once, it seems as though that's not the only way to make money here, at least from the investor point of view.
It's not the only way, but it's a contributing factor.
Yeah, it certainly is. Certainly is. Look, folks. Travelers, as we learned, bought back 58% of their float, Bill, after starting that share buyback program in 2006.
That's how they're putting their cash to work these days. They're not doing it in the traditional way in capital spending.